uh, Mr. Kapadia, Mr. Sandeep Khosla, Ms. Anjali Bansal, other office bearers and executive members of the Bombay Chamber of Commerce and Industry, all your members who are participating in this Zoom conference, and all the others who are also attending this, ladies and gentlemen. At first, I would like to extend my very warm good morning to all of you. I would like to begin by thanking the Bombay Chamber of Commerce and Industry for the invitation extended to me to address the imminent gathering, even if virtually, which has become the compulsive reality of the current times. My heartiest congratulations to the Bombay Chamber of Commerce and Industry for completing 184 years of successful functioning. Besides being the oldest serving chamber in the country, you have left a significant mark on the destiny of this city, that is Mumbai, as also of the nation. I am happy to note that under the aegis of corporate as a citizen, the Chamber is focusing on greater and more equitable progress by promoting ethical conduct of business, skill training, and balanced industrial growth. The theme that you have chosen this year, that is Corporates for Change, would not have been more apposite at the current juncture as articulated by Mr. Kapadia. I wish you all success in your endeavors. I'm sure the Chamber is striving hard to make the most of the new opportunities thrown in by the pandemic. In fact, in my address today, I propose to focus on the theme creating new opportunities for growth. And I would like to focus mostly on those areas. Before doing that, let me provide a slight background of the pandemic and where we stand in terms of the financial sector and the economy. While the pandemics are rare events, I'm talking at the global level now and also about India. While the pandemics are rare events and seldom replicate past episodes, studying their impact and policy responses provide valuable insights and backdrop to any discussion or interaction like this. Four such severe pandemic outbreaks in India have occurred, and they are 1896 plague, 1980, 1918 the Spanish flu, 1958 Asian flu, and 1974 smallpox. And they show that all these were associated with and followed by contraction and deceleration in GDP, with the 1918 Spanish flu remaining the mother of all pandemics in terms of loss of life and livelihood. The recovery, however, was observed to be swift and complete within 2 years of these outbreaks, except in the case of Spanish flu, where GDP per capita climbed back to the pre-outbreak levels. That is, it came back to what it was before the pandemic started, only after 4 years, and that was in 1922. Policy responses during these pandemics and after these pandemics had essentially focused on provisioning for medical and public health sectors, as well as offsetting the debilitating impact of the pandemic on the economy. It was seen that growth became excessively dependent on government expenditure, while timely and well calibrated exit from exceptional fiscal measures were critical for macroeconomic stability. Policy focus on boosting private consumption expenditure and investment was the key, was, they were in fact the key in reviving the economy on a durable basis. Now, I would just like to again touch upon what were the fiscal and monetary responses during the COVID-19 pandemic, which we are confronted with. The past 1 year has witnessed unimaginable misery and agony across the world, entailing large destruction of human life and wealth. Governments and central banks across the globe unleashed conventional and unconventional policy support to fight the devastating adverse impact, the negative impact of the pandemic. Globally, governments have unveiled large fiscal stimulus packages in 2020, amounting to nearly 14 trillion US dollars, 14 trillion US dollars, which is equivalent to about 13.5% of the world GDP. And this was done to contain the spread of the pandemic. And this is published, these details are published by the IMF in its latest report in 2021. Now, as a consequence of this, deficit and debt levels have soared, have increased across the world and across countries. In India also, the central government announced a series of economic packages, initially focusing on protecting vulnerable sections of society, followed by counter-cyclical measures to provide an impetus to consumption and investments for reviving and resurrecting growth. Central banks, on the other hand, had proactively designed and implemented various conventional and unconventional monetary policy measures based on their experience from past crises, notably the global financial crisis of 2008. And the proactive action and the intervention of central banks was visible across the world. Most central banks have lowered policy rates, widened the range of eligible counterparties, and eased collateral norms, while increasing the scale and tenor of repo operations. They also expanded their asset purchases programs to contain pandemic-induced elevated uncertainty and facilitate lower long-term interest rates. These measures were complemented by implicit and explicit forward guidance by communicating the stance of monetary policy going ahead. In India, the Reserve Bank undertook several conventional and unconventional measures in the wake of COVID-19. Now, other than the conventional measures, the Reserve Bank, as you would know, has undertaken measures like the long-term repo operations, the targeted repo operations to augment system as well as sector-specific liquidity. The Reserve Bank has also provided special refinance facilities to select all India financial institutions like the NABARD, SIDBI, and the National Housing Bank. Special liquidity facility was also provided for mutual funds, and that was done to ease the redemption pressures in the mutual fund segment of the economy. Unlike many other central banks, the Reserve Bank's asset purchase did not dilute its balance sheet and hence did not compromise on core principles of banking. These purchases were confined to risk-free, that is, I'm talking about Reserve Bank's asset purchase programs. The Reserve Bank purchases were confined to risk-free sovereign bonds, including state government securities, and the focus was to foster congenial financing conditions without compromising or without jeopardizing financial stability. Further, forward guidance also gained prominence in Reserve Bank's communication strategy to realize cooperative outcomes. Our commitment to ensure ample liquidity conditions supportive of recovery dispelled illiquidity fears in the market and bolstered market sentiments. We will continue to support the recovery process through the provision of ample liquidity in the system while maintaining financial stability. Let me now touch upon the impact of the pandemic on trade and balance of payments. The impact of COVID-19 induced deceleration on GDP and trade, if compared with the global financial crisis of 2008, reveals contrasting trends. Global GDP is estimated to have contracted by 3.5% during 2020, much higher than the contraction of 0.1%, which was witnessed during the global financial crisis of 2008. While on the other hand, global merchandise trade is estimated to have contracted only by 9.2% in 2020, as against a contraction of 22.3% during 2009. This differential pattern could essentially be attributed to the major role played by the domestic drivers across countries, induced mostly by lockdowns during the recent episode of the COVID-19 pandemic. Even though merchandise trade has shown incipient signs of revival since end of 2020. Recovery in services trade is yet to gain traction as subdued cross-border tourism and travel restrictions continue to weigh in on overall performance of this sector. Uneven global recovery led by a few Asian countries and select sectors such as medical equipment and electronic products raises concerns regarding their sustainability. A crucial impediment to revival of global trading activity is the continued disruptions on global supply chains, with steep increase in shipping costs since November 2020 and lengthening of delivery times leading to rising commodity prices. These issues call for urgent attention from the policymakers across the world. The impact of demand and supply shocks is also reflected in balance of payments. And now I'm mainly focusing on the overall global picture, then I'll come to India. Now, the impact of demand and supply shocks is also reflected in the balance of payments. While commodity exporting countries faced lower current account surpluses due to negative shocks to their net terms of trade, net commodity importing countries such as India benefited, recording either lower deficits or even surpluses. Lower crude oil prices and weak demand due to COVID-19 related lockdown in the early days of the pandemic squeezed India's oil import bill by 42.5% during April to January 2020-21. In contrast to goods trade, India's net services exports remained relatively resilient despite travel receipts and travel restrictions. And when I say travel receipts, I mean that despite travel receipts falling sharply due to travel restrictions. Unlike most of the other major economies, India's services exports of India gained traction from our software exports. Domestic information technology companies benefited from the growing global demand for core transformation services as their customers focused on new models for IT operations during the pandemic. Remittance inflows fell amid widespread job losses in host countries. Nevertheless, the decline in remittances was more than offset by lower trade deficit and robust net exports of services from India. As noted by the UNCTAD in a recent report of 2021, India's inward foreign direct investment, that is FDI, it bucked the global trend and grew positively in 2020, boosted by investments in mainly the digital sector. In 2020-21, that is April to December, net FDI to India at US dollar 40.5 billion was higher than 31.1 billion a year ago. India's optimistic growth outlook and ample global liquidity also induced net foreign portfolio investment of 35 billion US dollars in domestic equity markets in 2020-21 up to 19th of February. Non-residents also made higher accretion to deposits with banks in India. Consequently, the surplus on both current and capital account is reflected in buildup of foreign exchange reserves during the year. As on February 19th, 2021, foreign exchange reserves of India, that is RBI's foreign exchange reserves, were US dollar 583.9 billion, an accretion of 106.1 billion US dollars since end March 2020. The external sector outlook would continue to be reshaped by headwinds and tailwinds associated with both domestic and global recovery. Now with this background, let me turn to some emerging post-COVID opportunities in India. I would now like to focus on certain emerging post-COVID opportunities in India, for which I have listed out 7 key areas for special mention. The first one relates to manufacturing and infrastructure. The manufacturing sector is spearheading the growth recovery as many contact-intensive services subsectors are severely affected by the crisis. The initiatives of the government under Atmanirbhar Bharat Abhiyan and the Union Budget 21-22 towards developing a vibrant manufacturing sector and infrastructure acknowledges the strong linkages they have with rest of the sectors. The production linked incentive, that is PLI scheme, aims to make India an integral part of global value chain. This, along with reforms in labor market, can go a long way in propelling growth to an elevated trajectory for the manufacturing sector and reap its employment potential in India. The second area I would like to highlight is the micro, small, and medium enterprises, the MSMEs. I'm happy to note that MSMEs, that is small and medium enterprises in particular, account for about 2/3 of the current membership of the Bombay Chamber of Commerce and Industry. The micro, small, and medium enterprises, that is MSME sector in India, has emerged as the growth engine of the economy with a vast network of about 6.33 crore enterprises contributing 30% of our nominal GDP and 48% to exports. This sector employs 11 crore people, second only to agriculture. The sector has been rendered especially vulnerable by the pandemic, necessitating concerted efforts to combat the stress and focus on revival of the sector. In this regard, two major schemes, that is the Emergency Credit Line Guarantee Scheme ECLGS and the Credit Guarantee Scheme for Subordinate Debt, were introduced by the government. These have been duly supported by various monetary and regulatory measures by the Reserve Bank in the form of interest rate cuts, higher structural and durable liquidity, moratorium on debt servicing, asset classification standstill, loan restructuring packages, and CRR exemptions on credit disbursed to new MSME borrowers. As you know, for the MSME sector, even before the pandemic, on 1st January 2019, we had announced a major restructuring scheme. And once the pandemic set in, we again announced a scheme which said that assets which were standard assets as on 1st January 2020, that is my recollection, they also became eligible for a restructuring. These measures will not only help in ameliorating stress in the sector, but also open new opportunities. Going forward, the Reserve Bank stands ready to support the Small Industries Development Bank of India, that is the SIDBI, for greater credit penetration to the MSME sector. The third area I wish to highlight is technology and innovation, and this is again an area where I think the small units and many medium and small size units are playing a significant role and are gradually making their presence felt. Digital penetration in India has scaled a new high. The time has come to leverage its applications while at the same time strengthening the digital infrastructure. With approximately 1.2 billion wireless subscribers and 750 million internet subscribers, India is second largest and one of the fastest growing markets for digital consumers. As digital capabilities improve and connectivity becomes omnipresent, technological innovation and technology-driven revolution are poised to quickly and radically change India's economy. They have the potential to raise the productivity of agriculture, manufacturing, and businesses, as well as improve the delivery of public services such as health and education. In the financial sector, this could lead to higher financial inclusion, lesser information asymmetry, and reduced credit risk. Similarly, open online courses, audiovisual training programs, and remote learning can strengthen the match between skills required by the industry and the skills imparted in schools, colleges, and technical institutes. Healthcare delivery can be improved via digitization of medical records, remote provision of diagnosis, and prescriptions via smartphones and mobile internet. Technology adoption in rural areas for precision farming by using geographical information systems based soil, water, and climate data to guide farmers' farming decisions, as well as using real-time market information to guide sale of agro products, can add high value to the agricultural sector. The e-commerce sector, with its lower cost of transactions, is already revolutionizing the market structure, culminating in deeper market integration. I would like to point out that gross domestic expenditure on research and development in India is mainly driven by the government, with a share of 56% of the total R&D in India. It is important for India to become it is important that for India to become a global technology and innovation leader, the corporate sector should take the lead, as is the case in many emerging markets and advanced economies. The fourth area I wish to highlight, and I would be now very quick, I'll try and conclude very quickly. The fourth area I wish to highlight is health, the healthcare sector. Post COVID-19, the health sector has undoubtedly emerged as a major fault line, as well as the sector with tremendous growth opportunities. With a network of more than 3,000 companies, India now ranks third globally for pharmaceutical production by volume, with the sector generating a trade surplus of US$ 12 billion annually. India now supplies more than half of the global demand for vaccines. The sector is expected to witness strong growth in the coming years with its commitment to R&D and low cost of production. It is expected to supply a significant share of increased global demand for vaccines and medicines in the post-COVID scenario. Going forward, the focus should be more on enhancing overall supply of health services at every level of value chain in a cost-effective manner. Corporate sector needs to invest more to create scale and skill in this sector. The fifth area I would like to highlight is export push. And again, as I mentioned, the MSME units, and I'm highlighting and stressing this point because you have large number of MSME, promoters of MSME companies who are your members. So with the global economy gradually emerging, and with the global economy gradually emerging from one of its deepest recessions, global trade activity is also likely to get a cyclical upturn going forward. In the case of India, there has been focus on structural reforms that can set the foundation for robust growth and greater role of domestic industry in global value chain. Based on sectoral strengths and potential opportunities, the PLI scheme of the Government of India identifies a few champion sectors that will support domestic manufacturers in achieving economies of scale and expanding their footprint in the global market. The response from companies, particularly in electronics, pharmaceuticals, and medical device industry to this scheme, that is the PLI scheme, is reported to be very encouraging. This export push is likely to come from other sectors like food products, apparel and textiles, capital goods, automobiles and auto components, and electronics and semiconductors. Since the incentive structure under PLI scheme is envisaged for next 5 years, domestic industry needs to develop its strength by focusing on quality and export competitiveness in order to remain viable in the long run. The sixth area I would like to highlight is free trade agreements, the FTAs. Another policy area which needs focus for providing a durable push to India's exports and growth is the free trade agreements with key strategically important economies. The potential FTAs need to take cognizance of not only domestic strengths and global opportunities, but also the emerging geopolitical landscape in the post-pandemic period. While designing future FTAs, India's experience with FTAs can be a significant guidepost. Key considerations should be to identify countries and regions that not only have the potential as market for domestic goods and services, but also have the scope to enhance domestic competitiveness, that is domestic competitiveness of India, especially in sectors covered under the PLI scheme. The post-Brexit scenario offers a greater scope for having separate trade agreements with the UK and the European Union. FTAs with these economies can boost not only the bilateral trade and investment relations, but also may pave the way for greater collaboration in areas of scientific research and climate change. Due to favorable demographic dividend, Africa also offers immense potential for exports and investment from Indian firms. Large presence of Indian diaspora could help tap this potential. And finally, let me focus on that is the seventh area, that is services exports. Recovery in world services trade, which grew faster than merchandise trade in the pre-pandemic period, is expected to be slower due to cross-border travel restrictions being still in place. There has, however, been greater emphasis on carrying out business operations with efficiency. This has increased the demand for cutting-edge software, services, and new business opportunities brought on by the ongoing global value chain reconfiguration. This has also provided resilience to software exports of IT companies. A recent study by the WTO, that is in February 2021, in the current month, estimates that by 2020, global trade growth would be 2% higher annually on average because of adoption of digital technologies. This should open up new opportunities for trade by reducing trade costs and strengthening ties between global value chains. Given our renewed focus on digitization, India, by being the largest software exporting country, is expected to gain with increased servicification. Let me now conclude. Overall, we are on the cusp of a turnaround in fortunes. In contrast to rest of the world, the caseload of COVID-19 in India has declined, and it is crucial for us to consolidate this decline and capitalize on the success that has been hard earned. The infection caseload in some parts of the country is, however, again creeping up. We need to stay vigilant and steadfast and on our toes. The COVID war continues. The battle of 2020, the battle of 2020 has been won, albeit with significant costs in terms of lives, livelihood, and economic activity. We need to win the battle of 2021 also. Let us resolve to win eventually this war against COVID. Thank you very much for your patience. Stay safe. Namaskar. So I hand it back to Shruti. You are mute, I think.
Thank you, sir, for a very insightful address. May I request Ms. Anjali Bansal, Senior Vice President, Bombay Chamber, to moderate the Q&A session and to propose the vote of thanks, ma'am.
Good morning, Shri Das, and I'm indeed privileged today to perform both these tasks, to moderate the Q&A, and we've been getting a continuous stream of questions and comments from our members and participants. And then I will go into the vote of thanks. But let me first start with expressing our sincere appreciation for taking the time and more importantly, for everything you shared today. I think a very positive, balanced, cautious, but very positive message to all of us. One that focuses on the way forward, the battle of 2021, so to speak. And many energizing thoughts here around MSMEs, support for their growth, Atmanirbhar, exports, the focus on lives, livelihood, skilling, particularly because we are all conscious that the weaker segments of society have actually been disproportionately impacted, as well as around innovation, R&D. And India has been a software exporting nation, but the focus on IP, whether it is in technology, in healthcare, I think is a real opportunity for us moving forward, manufacturing as well. Agri and support for organizing, formalizing the agri sector. So lots to learn from what you have shared with us and lots to feel hopeful about. So on that note, I'm going to turn over to our questions that have come in, but let me start first with a very special hello to you from your batchmate, Ms. Amira Sagi, IAS. She's also one of, she's a proud Bombay Chamber member, our past president as well. And to see that she says that she is very happy to see you address the chamber today and to observe the very high regard the members of the chamber hold you in. And thank you for steering the RBI so effectively in recent difficult times. So that's from Neera.
Thank you. And I'm really happy that she's been able to participate in this. Thank you.
Terrific.
Thank you, Neera.
And then, needless to say, I'm going to start with a question that is that I would have asked you as well. So, from our office bearer and board colleague Ashit Kampani, what is your view, sir, on the roadmap and timelines for implementation of basically digitization? And I don't want to make it very simplistically about fintech, but really opening up the financial services sector, creating more inclusivity, making access to finance possible through digital, e-KYC, if you will. Ashita, I'm adding to your question here, and then very specifically digital currency infrastructure and timelines for digital bank license.
You see, over the last few years, the Reserve Bank is focusing a lot on digitization, on digital payments, and on promoting fintech and other similar activities. You would recall that we have set up a regulatory sandbox for fintech. We set it up sometime in 2019, and that is already the various cohorts. Under various cohorts, the various trials are already underway. And we have also announced the setting up of, and in fact, we have set up an innovation hub, which is already, there is a committee of management, there's a board of management that is already operational. Recently, with regard to digital payments, we have made both NEFT and RTGS 24/7 around the year. It is now 24/7 facility, which is available. And the NPCI has really, and the UPI together, they are really revolutionizing the payment and settlement systems in India. We are constantly focusing on upgrading our own internal IT systems and IT, the imbibing new technologies, etc. But coming specifically to the area of penetration of digital transactions, in fact, even if you take small examples like the QR code, for example, the QR code, we have now tried to make it, we have now sort of streamlined it, and we have said, instead of having multiplicity of QR codes and creating, confusion in the minds of the consumers, we have now said that henceforth there will be 2 QR codes which will be applicable, which will be available. One is the UPI QR code, the other one is the Bharat QR code, and all shops and establishments should have that. With regard to digital, digital currency, the Reserve Bank is already working on having a central bank digital currency, and which is, far different from the cryptocurrencies on which I have already articulated my views yesterday in an interview to a television, to a business channel. So I don't want again to go into that. But on digital currency, that is on central bank digital currency, a lot of work is going on internally in the Reserve Bank of India, and we will be coming out with some broad guidelines and approach paper very shortly. There are a few issues to be sorted out internally, and it's very much work in progress, and we don't want to be left behind in this technology revolution which is taking place. We need 2 aspects. One aspect is the technology part of blockchain technology, that the benefits of blockchain technology needs to be capitalized. The other aspect I am talking about is central bank digital currency. The third area which people, these days it's the flavor of the day in the media with regard to crypto, etc. As I mentioned yesterday, we have certain concerns, and we have already conveyed them to the government.
Thank you very much, sir. Noted on crypto as well. And I must add my commentary here a little bit, that one of the unanticipated consequences, positive consequences of COVID-19 pandemic has been the acceleration of digitalization. And I think India is very well positioned to really leap forward, because we've invested in creating the digital infrastructure, particularly for payments. So having India Stack, having UPI and NPCI doing very yeoman work there, I think it positions us, it's created the possibility of business models that would not have been possible even 5 years ago. I think NPCI and our UPI India stack are actually innovations. And they are government-led innovations and PPP models that we should be thinking about exporting to the world. So on that note, I will go to the next question. So there's a question around, what do you see impact on inflation in the near term due to the fuel price hikes? So you're on mute.
Yeah. Now, fuel price hikes, I have already articulated my views in the recently released NPC minutes. I don't know whether you had an opportunity to look at it, but I will articulate them once again. Diesel and petrol prices do have an impact on the cost side, and they play a role. They act as cost push factors in across a spectrum of across a range of activities. And so therefore, it's not just the passengers who are using the cars and the scooters and all that. I mean, that is a different set of people. High petrol and diesel prices do have an impact on cost of manufacturing and cost of transportation and other aspects. So on this, there is need for a coordinated action between the center and the states, because there are indirect taxes levied both by the center and the states. And there is need for coordinated action and a coordinated, calibrated reduction of taxes. At the same time, we do realize that governments, both central government and state governments, have their revenue pressures, and they are required to spend higher sums of money to enable the country and the people to come out of the COVID stress. So the revenue requirements and the compulsions of the government are fully understood. But having said that, the impact on inflation also is something which comes in from the fact that petrol and diesel prices do have an impact on the cost of manufacturing and on the cost of production. So I'm sure going forward, both the central and the state governments will take some positive decisions in a coordinated manner.
Thank you. Next one is on the bad bank, so to speak. This is from Dr. Rajendra Sinha. And from the budget mentioned that an asset management company will be set up to manage and handle bad loans and bad assets. The specific question is that instead of having a new AMC, the ARCs that have already been in existence, should they not be strengthened? How will the new initiative be more effective?
You see, there are two aspects. One is strengthening the ARCs. We have a certain regulatory framework for the ARCs. And recently, if you look at, let's say in the last 1 or 2 years, steadily we are sort of focusing on one sector after the other sector. We refined our, regulatory architecture in respect of the MFIs. Now we are focusing on, so not the MFIs, I mean the NBFCs. We have already come out with a different regulatory architecture. There's a discussion paper on governance also in NBFCs. That discussion paper is very much in public domain. And we have refined the regulatory architecture. In the MFI sector, that is in the microfinance institution sector, we are also working on upgrading and improving our regulatory architecture. In cooperative banking sector, we have done that. In the digital arena, a lot of work is going on. Excuse me. So therefore, ARCs is one area which is very much receiving our attention, refining there and further upgrading and the regulatory architecture in respect of the ARCs to ensure that they have a skin in the game and they are very much in business. That is one aspect. It's receiving a lot of attention from us. I have had myself one interaction with some ARCs in the recent, not very recent, but about a year ago, and we had certain plans, but then the COVID came in between. But that is an area where refinement of regulatory architecture for ARCs is very much on our table. The other aspect is this proposal of the government I think that is a bank-led initiative. The public sector banks together have come forward and given a proposal to government, which the government has accepted and announced in the budget, that a ARC type, what you call a bad bank, it's not really a bad bank. An ARC type entity will be set up to take over the stressed assets, the NPAs from the books of public sector banks, and to sort of try and resolve them like any other ARC, they are doing it. So that is a proposal which has come forward. And so that is targeting a specific set of bad assets which the certain group of public sector banks they hold it. And it is an initiative which has come from the public sector banks. In no way it will jeopardize the activities of the existing ARCs. I think there is scope to have one more strong ARC formed by the banks themselves.
So follow on to that, sir. And it comes from a place of personal experience, having chaired a very stressed public sector bank previously, non-executively, I must add, after the bank went under RBI imposed PCA. What can we do going forward as India moves into the next economic growth cycle, which we all hope it does, and credit starts flowing and bank books start and asset books start getting sort of larger again? What is your view on how to make sure we do not end up in this very difficult situation of very large stressed asset sitting in public sector bank books and even private sector bank books for that matter? So you're on mute.
Sorry. No, in fact, there is growing realization. In fact, there is growing realization, and there is a greater amount of realization and awareness among banks with regard to dealing with bad assets. Even in the context of the asset classification standstill, which has been ordered by the Supreme Court, and the final orders are expected. The final orders are expected anytime. I mean, it's for the court to decide, but the final orders are expected from the Supreme Court. Even during this period, the banks have been making proactive provisioning in their books. And totally, the provision coverage ratio of all the banks, the scheduled commercial banks in India is today 75%. That is the provision coverage ratio of the stressed assets. So it's a significant improvement over what had happened earlier. From Reserve Bank side, we have sharpened and deepened our supervisory methods. We are now doing a deep dive into areas of banking which were not done earlier. We are looking into business models of banks. We are looking into potential potential vulnerabilities and fragilities building up in the banks. So we have sharpened our supervision. Secondly, it's a kind of a ongoing supervision which is now going on in the Reserve Bank, because we have the acrylic data and we have a precise idea of what quantum of assets are, where the default is up to 30 days, the default in repayment is up to 60 days, and the default in repayment is up to 90 days and beyond. We have a data system called the acrylic data system, wherein the information flows in online from the banks, scheduled commercial banks, into the acrylic data system of the RBI. So we have a precise idea of the buildup of stressed assets in banks. And as soon as we see a sign of stress, we immediately enter into a discussion with the banks and proactively deal with these problems. So that is also being dealt with. The third aspect is the appraisal skills of the banks themselves. I think this is one area which requires, where there is need for governance, focus of the bank management on improving their appraisal skills, and on, taking measures to see that the evergreening of loans, which were happening at some point of time, the evergreening of loans also is suitably plugged. So therefore, today the Indian financial sector is far in a much better place than it was earlier. We have a fairly clear idea about the size of the bad assets that is building up in the system. we are constantly engaged with both public and private sector banks to deal with this issue. The key to all this, apart from RBI's supervisory and regulatory initiatives, the key to all these issues is improving governance in banks, both public and private sector. And I have spoken about it at length earlier. And so therefore, I don't wish to go into further details on this, but governance, functioning of the risk management committees of banks, functioning of the audit committees of the banks, functioning of the board of the banks itself, independent directors playing their role, the bank management having appropriate risk management skills internally and taking proactive and timely action. So ultimately, it boils down to governance in the scheduled commercial banks.
Thank you. And I could not agree more, sir. I think you've put a pin in it by saying ultimately it's about governance. And as we know, governance is about form and function and process, but it is at its core, it is about intentionality. So point well taken. I'm going to shift to two questions on MSMEs specifically. Banks are not keen on offering CGMTSE schemes for startups because a lot of startups, according to the DPIIT definition, less than 100 crores, less than 10 years old, are actually also MSMEs. How do we overcome this challenge for our new MSMEs and startups, and particularly those in the sunrise sector, which may not have assets, they don't have your classical definition of assets that can be collateralized, or long histories or of profitability either. So I know there is work happening through other forums with the government, but very keen to hear your views on this. So MSMEs, startups, sunrise sector. And another question around MSMEs, which is different, is around supporting exports and helping MSMEs manage the exchange rate fluctuation. There is an example that China has helped MSMEs through a methodology that insulates MSMEs that are exporting from exchange rate fluctuation. So 2 points: startup MSMEs, extension of schemes to them. And the second is about classical MSMEs and exports.
With regard to extension of loans under various schemes of Government of India, I think you will agree that it's a government scheme and the implementation lies in the domain of the government and the banks themselves. So far as RBI is concerned, we do not interfere in the lending decisions and credit decisions of individual banks. Our job is to provide a regulatory framework, regulatory dispensations to address the requirements of a particular sector, be it startups, be it MSMEs. So our job is to provide a regulatory architecture, a regulatory framework to facilitate smooth flow of credit. Our function is also to provide regulatory dispensations to areas of stress in the economy, like we announced the COVID-related stressed asset resolution framework last year in August. So with regard to lending decisions, we really do not interfere, and its lending decision is a commercial decision for the banks to take. But from regulation side, if there are any impediments in any particular sector or in any particular area of credit flow, the RBI will certainly address these issues. And so that is how I would like to explain. The second point which you mentioned about exports. Now, with regard to exports, RBI's focus is to ensure to prevent excessive volatility in the exchange rate. You will see that even during the COVID times, the rupee fluctuation is, the fluctuation of the rupee has been within a particular range. It has not really depreciated. It reached about 76.90, 76 rupees 90 paisa per dollar briefly at the beginning of the COVID, but then immediately rupee appreciated and it came down. So it has remained within a narrow range. So RBI's responsibility is to ensure that there is stability of the exchange rate, and our focus is always to prevent undue volatility, so that the exporters or even the importers, because both of them are dependent on the exchange rate, and even the the other businesses or the investors themselves, they can take informed decisions. And the RBI's continuing policy will be to prevent excessive volatility. So once we prevent excessive volatility, I think the concern of every sector, including the MSMEs, would be addressed.
Thank you. I'm just going through questions. The last one on MSME startups came from the co-chair of our MSME committee, Dr. Vinod Chopra. From Partha, who is our past president as well, from Mahindra & Mahindra, question around there seems to be an upswing in cases, and you talked briefly about COVID. Any guidance on how bodies like us as a chambers, what can we do to help?
I think today, everybody, when the COVID curve slightly flattened, I think people thought that we are out of the problem. And, I think we, in certain areas and certain people and certain establishment, probably, I mean, I can only say anecdotally, I don't have statistical backup for that, but anecdotally, it was quite visible that people were lowering their guard. I think we need to remain as careful as we were last year in around April, May, in the early part of the COVID pandemic, wearing of the mask and following all the social distancing norms, keeping your washing of the hand. I mean, these are the essential discipline which one has to play. Associations like the Bombay Chamber of Commerce and Industry and other industry and commerce bodies, I think the need is to sensitize the members, because like in an MSME unit or any manufacturing unit, there'll be a lot of there'll be a lot of people working within a defined space. So how to maintain social distance in those areas? I mean, there are staff, there are personnel, there are workers who are going into the canteen. So I think the focus should be on following on all these protocols with regard to social distance, etc. Even within business establishment, in shop floors, in factories. Basically, I think the focus has to be on awareness. And I mean, there is great amount of awareness today. If you see, I mean, there is great amount of awareness, far better than what we witnessed in the early part of the pandemic. So I think associations need to focus on these areas. And before I conclude, since you said this is the last question, let me say, to Bombay Chamber, I mean, I would like to assure you that I have been interacting with personally with all the chambers of commerce and industry, and Mr. Sudhir Kapadia, on behalf of the Bombay Chamber, has been participating in our interactive sessions. Now, if at any point of time you have any issues or any suggestions or any points of view which you would like to sort of take up with the Reserve Bank, you are most welcome. You can approach us. If not me, our senior officers will definitely, I will try depending on time factor, but our senior officers will interact with you to address all your concerns and to consider all your suggestions. The doors of the central bank are always open for you.
Thank you very much, sir. And I will propose a formal vote of thanks to Shri Shaktikanta Das, Governor, Reserve Bank of India, for his very insightful address. And you're very patient listening to all our questions and addressing all our questions. I'm sure you get asked these questions all the time. I also want to thank our partners for their kind support for our Foundation Day event, Tata Power Company Limited, Excel Industries Limited, Revati Industries, and Nichem Solutions. I want to thank our board members, all the attendees and participants. And we would not complete our thanks without a special vote of thanks to Mr. Bharat Doshi, our past president and a very good friend and colleague of ours, for his kind effort and support in making this happen. So thank you, Bharat. If you have dialed in, that's great. Otherwise, you have our heartfelt thanks. And very importantly, to our DG, Sandeep Khosla, and our absolutely tireless, wonderful, committed team at Bombay Chamber, the Secretariat and all the team members without whose consistent and strong support, nothing we do could be possible. So once again, thank you all very much. And sir, we know that tomorrow is your birthday. So wishing you a very happy birthday in advance.
Happy birthday, sir.
Happy birthday.
Thank you and namaskar. Thank you very much.
Namaskar. Thank you very much.
Thank you.